6 figures in your bank account feels like a finish line. It feels like proof. Proof that you were disciplined. Proof that you did things right. Proof that you are finally safe. But $100,000 is not safety. It is a decision point. For years, your life has likely revolved around earning. Getting promoted, negotiating raises, building skills that increase your income. Every milestone was measured by how much you could bring in. Then one day, you look at your account and see it. $100,000 saved. But then something subtle happens. You relax. You start thinking you've arrived, that you've crossed into a different category of people, that you've stepped out of financial vulnerability. But if $100,000 truly meant freedom, you wouldn't still feel tied to your job. You wouldn't hesitate to walk away from a paycheck. You wouldn't feel that quiet pressure in the back of your mind reminding you that the bills still depend on your time. That tension reveals the truth. $100,000 is not wealth. It is capital, and capital is not meant to sit still. Capital demands direction. It forces a shift in identity, because up until this point, you've been rewarded for earning money. From this point forward, you will only build real freedom by owning systems. There are 2 instincts that show up at this level. The first is the worker instinct. Protect it. Guard it. Don't lose it. Keep it safe. The second is the owner mindset. Deploy it. Structure it. Make it productive. One instinct preserves comfort. The other builds leverage. That is the separation. A worker looks at $100,000 and sees a cushion, a buffer, a reason to feel secure. An owner looks at $100,000 and sees fuel, a down payment on assets, seed capital for systems that operate without constant effort. If your money only grows when you work, then you are still the engine, and engines wear out. $100,000 is enough to create the illusion that you're ahead. But it's also enough to create something that works independently of you if you treat it as capital rather than savings. Left idle, it slowly loses power. Inflation chips away at its value. Opportunities pass. Time compounds quietly, whether you act or not. Used strategically, it becomes something else entirely. It becomes ownership. It becomes cash flow. It becomes a structure that separates your income from your hours. The critical mistake at this stage is believing that earning more is the next step. Another promotion, another raise, another year of accumulation. But earning alone does not change your position. It only increases your dependency on your ability to keep earning. Ownership changes the equation. Workers focus on income. Owners focus on control. Workers ask, how much can I make this year? Owners ask, what can I own that will make money without me? That question transforms everything. Because once your money begins producing, your relationship with time shifts. You no longer trade hours for dollars at a 1-to-1 ratio. You begin building systems that operate in the background. This is not about taking reckless risks. It is not about speculation or chasing trends. It is about structure. At $100,000, you are standing at a quiet but powerful crossroads. One path leads to becoming a highly paid worker, comfortable, successful, but still dependent on effort. And the other path leads toward ownership. Slower at first, but exponentially more powerful over time. The difference between the 2 paths is not talent. It is not intelligence. It is not luck. It is a decision. In the next 60 minutes, we will break down the exact shift that separates those who stay in the cycle of earning from those who step into ownership. The shift that determines whether $100,000 becomes a temporary milestone or the foundation of long-term freedom. Because the number itself will not change your life. What you choose to do with it will. 1. $100,000 is not wealth, it is capital. A bank balance can change how you feel long before it changes how you live. When you see $100,000 sitting in your account, something psychological shifts. You stand a little taller. You feel more responsible, more established, more in control. But confidence is not the same as structure. Wealth is not a number. Wealth is a system, and $100,000 by itself is not a system. It is stored effort, it is compressed time, it is delayed consumption. But until it is positioned correctly, it is not productive. This is where the confusion begins. For most of your life, money has been the scorecard. The higher the number, the better you were doing. More income meant more progress, more savings meant more discipline. So naturally, reaching six figures feels like leveling up. But earning and saving are only phase 1. Ownership is phase 2, and many people never transition. They accumulate, they protect, they hesitate. Because once you cross into six figures, losing money feels heavier. The fear increases. The instinct to defend becomes stronger. That instinct is understandable, but it keeps you small. Capital that is never deployed never multiplies. Money sitting idle is like machinery still in its packaging. It looks impressive, it has potential, but it produces nothing. The difference between someone who stays a worker and someone who becomes an owner is not how much they save. It is what they do. Once saving is no longer the challenge. At $5,000, your focus is survival. At $20,000, your focus is stability. At $100,000, your focus must shift to structure. If it doesn't, you stall. Because there is a ceiling to how much effort alone can produce. Your time is finite. Your energy is finite. Your attention is finite. Capital exists to remove those limits. When structured properly, money becomes leverage. It separates income from hours. It creates distance between your survival and your labor. That is what ownership actually means. Ownership means your financial life no longer depends entirely on your next task, your next meeting, your next shift. But that only happens if you stop thinking of $100,000 as my savings and start thinking of it as my deployment capacity. There is a subtle but powerful shift in language there. Savings implies protection. Capital implies responsibility. Protection keeps you where you are. A responsibility forces you to build, and building requires a different kind of thinking. Workers measure progress in pay increases. Owners measure progress in assets acquired. A worker asks, how secure is my job? An owner asks, how secure is my cash flow without my job? That distinction becomes unavoidable at six figures, because $100,000 is large enough to start acquiring real assets. It can become equity in real estate. It can become a meaningful brokerage account. It can fund a small business or buy into one. It can diversify across income-producing vehicles. It is enough to move from theory to action. Yet many stop there. They treat the number as sacred, untouchable, a trophy rather than a tool. But trophies do not compound. Tools do. Compounding does not begin with earning more. It begins with positioning what you already have. Every dollar has two possible roles, consumption or production. At $100,000, that choice becomes magnified. And because small decisions now have larger consequences. A conservative mindset may preserve the number, but preservation alone does not create expansion. This is where ownership demands clarity. Capital must be aligned with assets. Assets must generate cash flow or growth. Growth must be structured to outpace inflation and time. Otherwise, you are simply holding stored labor, and stored labor eventually loses power. The goal is not to gamble. The goal is not to rush. The goal is to convert. Convert money into something that works. Convert effort into equity. Convert savings into systems. That conversion is what separates levels. Without it, $100,000 is just a larger version of $10,000. With it, $100,000 becomes a launch pad. It is not about being aggressive. It is about being intentional, strategic, structured. Because the real value of capital is not in its size. It is in its position. And the moment you understand that, you stop asking, how do I protect this? You start asking, where does this belong? That is the beginning of ownership. 2. The worker instinct is hard to kill. Earning money trains you in a specific way. It trains you to associate effort with reward, time with income, security with consistency. For years, maybe decades, your survival has depended on showing up, performing, delivering, and getting paid. That rhythm becomes normal, predictable, safe. So when you accumulate $100,000, your first instinct is not expansion, it is protection. You think about market crashes, recessions, bad investments, mistakes. You remember stories of people who lost everything. You tell yourself that slow and steady is safer, that holding cash is responsible. And emotionally, that feels right, because the worker instinct is built on avoiding loss. A worker survives by minimizing risk, by being reliable, by staying within defined boundaries. That instinct is rewarded in school, in corporate life, in traditional careers. But ownership operates differently. Ownership is not reckless, but it is decisive. Now, the worker instinct says, don't lose what you earned. The owner mindset says, position what you earned. Those are not the same thing. The worker fears volatility. The owner understands structure. When markets fluctuate, the worker sees danger. The owner sees cycles. When interest rates rise, the worker sees uncertainty. The owner sees pricing adjustments. The difference is not intelligence, it is orientation. Workers are trained to think short-term survival. Owners are trained to think long-term positioning, and that training runs deep. You might tell yourself you want ownership. You might read about investing. You might understand compounding in theory. But when it's your $100,000 on the line, emotion surfaces. Because this money represents more than numbers. It represents years of discipline, sacrifice, late nights, early mornings, saying no to vacations, delaying gratification. Losing part of it feels like losing part of yourself. That is why the worker instinct is hard to kill. It ties identity to protection, but capital cannot grow if it is emotionally guarded like a fragile object. Ownership requires separating identity from money. You are not your account balance. You are not your savings rate. You are not your past effort. Money is a tool, and tools are meant to be used. The worker instinct asks, what if it goes down? The owner mindset asks, what is the structure behind it? This is where maturity comes in. Ownership is not about chasing returns. It is about understanding risk properly. There are two kinds of risk: the visible risk, price fluctuations, temporary losses, headlines, volatility, and the invisible risk, stagnation, erosion, missed compounding, dependency on labor. Workers obsess over visible risk. Owners manage invisible risk. Holding $100,000 in cash feels safe because you can see it. You can open your banking app and confirm it's still there, but over time, NIM inflation quietly reduces what that money can buy. Opportunities pass, assets appreciate, businesses scale, markets recover and grow. The risk of doing nothing compounds silently. That is the hidden danger. Ownership thinking reframes the question entirely. Instead of asking, how do I avoid losing money? It asks, how do I avoid wasting time? Because time is the asset you cannot replenish. Capital plus time equals leverage. Capital without time awareness equals delay. The worker instinct also seeks permission. It looks for certainty. It wants guarantees before acting. Ownership rarely offers guarantees. It offers probabilities. It offers structure. It offers positioning, and positioning always involves movement. This does not mean gambling your $100,000. It does not mean betting on speculative trends or chasing hype. It means accepting that money must be placed into productive environments. assets that produce income, assets that appreciate, the assets that scale. The worker instinct sees movement as danger. The owner mindset sees inactivity as danger. That reversal is critical. At $100,000, you are no longer in survival mode. You are in transition mode. The question is whether your psychology has caught up to your balance. Because the biggest barrier between workers and owners is not knowledge, it is conditioning. And conditioning does not disappear automatically just because your account reached 6 figures. It requires a conscious shift. A shift from defending money to directing money, from fearing temporary decline to prioritizing long-term control, from protecting effort to building equity. That shift is uncomfortable at first, but without it, $100,000 remains a milestone. With it, $100,000 becomes momentum. And momentum is what ownership runs on. 3. Owners think in systems, not salaries. A salary is linear. You work, you get paid, you stop. The money stops. It does not matter how high the salary is. It does not matter how impressive the title sounds. The structure remains the same. Linear input. Linear output. Ownership is different. Ownership is structural. You build once. It produces repeatedly. It scales without requiring equal effort every time. That is the core shift. Workers optimize income. Owners optimize systems. And a worker negotiates for a 10% raise. An owner asks how to acquire an asset that compounds at 8% for 20 years. A worker measures progress by annual earnings. An owner measures progress by accumulated equity. These are not cosmetic differences. They are structural differences. A salary increases your lifestyle. A system increases your leverage. When you have $100,000 saved, you are no longer limited to thinking about survival. You are capable of thinking about structure. But many do not. Because a salary feels certain, predictable, controlled. Systems feel uncertain at first. They require setup, decision-making, patience, exposure to volatility. So the default path is to double down on what feels familiar. Earn more. Another certification, another promotion, another year of accumulation. But earning more does not change the architecture of your financial life. If your expenses rise with your income, your dependence remains intact. And if your lifestyle expands every time your paycheck does, your margin stays thin. That is the trap of the high-income worker. They look successful, they live comfortably, but they are structurally fragile. Because their entire financial engine is powered by continued performance. Ownership removes that fragility. When you acquire income-producing assets, real estate, businesses, equities, intellectual property, you are no longer relying solely on personal output. You are building layers. Layers create resilience. Imagine 2 individuals, each earning $150,000 per year. The first has no assets beyond a retirement account they rarely contribute to. They upgrade their home, their car, their vacations. Most of their income circulates through consumption. The second keeps their lifestyle stable and uses excess capital to acquire rental properties, dividend-paying stocks, or ownership stakes in businesses. 10 years later, both may have earned similar salaries, but one owns systems, the other owns expenses. That is the difference. Systems create optionality. When markets dip, owners with diversified assets can adjust, rebalance, or hold. When job markets tighten, owners with passive income are not forced into desperation. When opportunities arise, owners with equity can leverage it. Workers, even high earners, are often constrained by cash flow, tied directly to employment. The goal is not to abandon work. The goal is to detach survival from work. That detachment only happens through systems. A system is anything that produces income, growth, or equity without requiring your constant presence. a rental property, collecting rent, a portfolio generating dividends, a business that runs with management in place. Digital products that sell while you sleep. Each of these represents structure. Structure compounds. Compounding is not magic, it is repetition over time. Small percentages applied consistently. Income reinvested. Assets layered. The workers think in years. Owners think in decades. Workers ask, what will I make this year? Owners ask, what will this asset be worth in 20 years? That time horizon changes behavior. When you extend your timeline, short-term volatility becomes less intimidating. Temporary declines become noise rather than threats. You focus less on price and more on position. Position is everything. Owning assets means you participate in growth, in productivity, in value creation beyond your own labor. When you own equity in a company, you benefit from its expansion. When you own property, you benefit from its appreciation and income. When you own intellectual property, you benefit from distribution. Ownership aligns you with growth. Employment aligns you with effort. There's nothing wrong with effort. Effort builds capital, but effort alone cannot create exponential outcomes. Systems can. At $100,000, you have enough capital to begin thinking like an owner. You can diversify. You can allocate strategically. You can structure your portfolio with intention, but only if you stop measuring success by income alone. Income is a tool. Ownership is the objective. When income becomes your primary metric, you chase raises. When ownership becomes your primary metric, you chase assets. And assets, over time, change your relationship with work entirely. Work becomes optional. Negotiations become stronger. Risk tolerance becomes rational. Because you are no longer negotiating from survival. You are negotiating from structure. The shift from salary to system is not dramatic. It does not require quitting your job or making extreme bets. It requires relocating attention from how much you earn to what you own, from increasing pay to increasing equity, from trading hours to building leverage. That shift is what separates workers from owners, and at $100,000, you are fully capable of making it. 4. The hidden risk of doing nothing. Risk is often misunderstood. When people think about risk, they picture dramatic losses, market crashes, failed businesses, bad tenants, headlines filled with panic. That is visible risk. It is loud. It is emotional. It gets attention. But there is another kind of risk that rarely makes headlines. The risk of standing still. When you reach $100,000, the instinct to protect becomes stronger. You tell yourself that preserving capital is responsible, and that caution is wisdom, that waiting is patience. But waiting without structure is not strategy. It is delay, and delay compounds just as powerfully as growth does. Money that sits idle loses purchasing power. Inflation does not need to be dramatic to be destructive. A steady erosion of 3% per year may not feel urgent, but over a decade it reshapes what your money can actually do. What costs $100,000 today may cost far more 10 years from now. Time does not pause because you are cautious. Opportunity cost is the silent force most people ignore. If your capital earns 1% while assets elsewhere grow at 7%, the difference is not just 6%. It is exponential over time. That gap widens every year, and once enough years pass, it becomes nearly impossible to close. This is the mathematics of inaction. Doing nothing feels safe in the present, but it quietly increases long-term vulnerability. Because when your capital does not grow, your dependency remains fixed. Your job must carry more weight. Your future savings must work harder to compensate for lost time. Owners understand that risk is not simply about loss. It is about exposure to stagnation. Stagnation is dangerous because it disguises itself as safety. When your account balance remains the same month after month, it feels stable, but stability without growth is fragile. The world moves forward, costs rise, markets expand, innovation continues. And if your capital does not participate in that movement, it falls behind. Falling behind is rarely dramatic. It is incremental, subtle, gradual. But over 10 or 20 years, gradual decline becomes structural weakness. Workers often measure risk by short-term volatility. If the number goes down temporarily, they feel threatened. Owners measure risk by long-term trajectory. If the structure fails to grow, they feel exposed. That distinction changes behavior. No temporary decline within a strong system is tolerable. Permanent stagnation is not. The fear of visible loss keeps many people from embracing structured growth. They wait for perfect conditions. They wait for clarity. They wait for certainty. Certainty rarely arrives. Markets cycle. Economies fluctuate. Interest rates shift. News remains unpredictable. Waiting for perfect timing often results in permanent hesitation. Owners operate with disciplined allocation, not perfect foresight. They diversify. They position capital across different vehicles. They manage downside intelligently, but they move. Movement does not mean recklessness. It means intention. At $100,000, you have enough to distribute risk rather than concentrate it. You can allocate across equities, real estate, fixed income, or private ventures. You can create balance between income-producing and growth-oriented assets. Inaction concentrates risk in a different way. It concentrates your future on continued employment. If your wealth does not grow independently, your career must do all the heavy lifting. And careers are subject to factors outside your control. Corporate restructuring, technological disruption, economic downturns. When capital grows, it becomes a counterweight to uncertainty. When it remains static, uncertainty compounds. There is also a psychological cost to inaction. When you avoid deploying capital out of fear, you reinforce that fear. You strengthen the worker instinct. You teach yourself that preservation is safer than positioning. Over time, this mindset becomes rigid. You grow increasingly resistant to change. You become protective rather than strategic. Ownership requires adaptability. It requires accepting that short-term fluctuation is part of long-term growth. Consider the difference between a savings account and a diversified portfolio. The savings account rarely moves. It provides predictability. But predictability at low yield rarely builds independence. A diversified portfolio moves daily. It fluctuates. But over long periods, it trends upward because it participates in productivity and expansion. The choice is not between risk and safety. It is between visible volatility and invisible erosion. Invisible erosion is harder to feel, but it is just as real. At $100,000, you're not choosing whether to take risk. You're choosing which risk to accept. The risk of temporary fluctuation within a structured plan, or the risk of long-term stagnation. Owners accept calculated volatility in exchange for structural growth. Workers accept structural stagnation in exchange for emotional comfort. That trade-off determines trajectory, because money left idle does not build options. It does not create leverage. It does not accelerate timelines. It waits, and while it waits, time advances. Time rewards those who deploy early and consistently. It punishes those who delay indefinitely. You cannot rewind 10 years of missed compounding. Thus, you cannot reclaim opportunities that passed while you hesitated. That is why doing nothing is not neutral. It is a decision, and like all decisions, it has consequences. The question at $100,000 is not whether you can avoid risk entirely. It is whether you are willing to design your exposure intelligently. Because avoiding visible risk often means embracing invisible decline. and invisible decline is what keeps workers working long after they're expected to stop. 5. Money must become a machine. Capital that sits is static. Capital that is structured becomes mechanical. A machine does not rely on motivation. It does not depend on mood. It does not require constant supervision. It runs because it was designed to run. That is what your $100,000 must become. Not a cushion, not a trophy, not a symbol of discipline. A machine. When money becomes a machine, it performs a specific function. It converts capital into ongoing output, and that output can take different forms: cash flow, appreciation, equity growth, reinvested returns. But the core principle remains the same. Money must produce. Workers are trained to produce income personally. Owners design structures that produce income independently. If you are the only engine in your financial life, your capacity is limited by your time, your health, your focus, and your career path. Machines expand capacity. A rental property is a machine. A dividend portfolio is a machine. Yet a business with systems and management is a machine. Even a well-structured index fund portfolio is a machine. Each of these converts capital into output over time. The output may fluctuate, it may vary year to year, but it functions beyond your daily effort. The mistake many people make at $100,000 is believing they must choose between safety and growth. They assume that turning money into a machine means taking extreme risks, quitting their job, starting something volatile, betting heavily on uncertain outcomes. That is not ownership. Ownership is design. Design considers risk tolerance, time horizon, liquidity needs, and diversification. It spreads exposure rather than concentrates it. It builds gradually rather than dramatically. A machine does not need to be aggressive to be effective. It needs to be consistent. Consistency over time is what turns modest returns into meaningful wealth. If $100,000 earns 7% annually, and that growth is reinvested, the long-term outcome is transformative, not because of brilliance, not because of luck, but because of structure. Structure compounds. The goal is not to maximize return in a single year. The goal is to create a system that continues operating for decades. Decades are where real leverage lives. Workers often focus on annual bonuses, quarterly results, yearly raises. Owners think in 10-year blocks, because 10 years of compounding is different from 1 year of effort, and 10 years of reinvested dividends, 10 years of rental income increasing gradually, 10 years of equity appreciation. These layers accumulate silently. Silence is often mistaken for inactivity, but quiet growth is still growth. Machines do not announce themselves. They operate in the background. They build momentum while you focus elsewhere. The key question is this: is your $100,000 positioned to produce something next month? If the answer is no, then it is not yet a machine. Nay, it is stored potential. Potential is not progress. Progress requires activation. Activation does not mean recklessness, it means allocation. Some portion into growth assets, some portion into income-producing assets, some portion reserved for liquidity and opportunity. Allocation turns money from passive to productive. Workers are paid once for each unit of effort. Owners are paid repeatedly for each unit of capital deployed. That repetition changes everything. Look, imagine your $100,000 producing even $5,000 per year in additional income. That income can be reinvested. The reinvested amount increases output the following year. The cycle repeats. Now imagine that process continuing for 20 years. The original $100,000 becomes secondary. The machine becomes primary. This is why ownership is less about the starting number and more about the structure behind it. A person with $100,000 in a productive system may outpace someone with $250,000 sitting idle. Because idle capital does not multiply. It decays relative to the economy. The transition from worker to owner is marked by one realization: money is not meant to rest, it is meant to rotate. Rotation through markets, rotation through assets, rotation through reinvestment cycles. Every rotation increases leverage. Every reinvestment strengthens the machine. Eventually, the machine reaches a point where its output covers a portion of your living expenses. Then a larger portion. Then perhaps all of them. At that moment, something fundamental changes. You are no longer forced to trade time for survival. You can choose to work. You can choose to scale further. You can choose to diversify more aggressively. Choice emerges from machines. Without machines, choice is limited. The beauty of starting at $100,000 is that you do not need to build everything at once. You only need to begin converting capital into productive form. One asset at a time, one allocation at a time, one reinvestment cycle at a time. Ownership is not a single leap. It is a sequence. But that sequence must begin with a decision to stop viewing money as stored labor and start viewing it as infrastructure. Infrastructure supports growth. Growth supports independence. Independence supports freedom. And freedom is built on machines, not salaries. And here is the deeper layer most people overlook. A machine does not eliminate work. It changes the nature of work. When your money becomes productive, so your effort shifts from survival to optimization. You are no longer working just to maintain your lifestyle. You are working to improve systems, refine allocations, and increase efficiency. That is a completely different posture. Survival work is reactive. Ownership work is strategic. When all of your income comes from labor, you're constantly reacting to immediate demands, deadlines, bills, market conditions, corporate decisions. When part of your income comes from machines, you gain breathing room. Breathing room creates clarity. Clarity improves decisions. Improved decisions compound. This is why the early years of building systems are often underestimated. The visible results may seem modest, but internally, your financial structure becomes more stable, more layered, more resilient. Resilience is the quiet advantage of ownership. If one income stream slows, another continues. If one asset underperforms, another offsets it. Diversified machines create balance, and workers rarely experience balance. Their financial life is often concentrated in a single source, their job. That concentration increases anxiety. Because any disruption feels catastrophic, machines reduce concentration risk, they distribute exposure, they create buffers, and over time, they build confidence that is rooted in structure rather than optimism. Confidence rooted in structure is durable. It does not disappear because of a headline. It does not collapse because of a temporary downturn. It is based on design, not emotion. The moment your money begins producing independently, your identity shifts. You stop identifying solely as an employee. You begin identifying as an allocator, an investor, an owner, a builder of infrastructure. That identity change matters, because identity influences behavior. If you see yourself as someone who builds systems, you will naturally look for opportunities to expand them. You will think about efficiency. You will analyze returns. You will prioritize reinvestment over consumption. But if you continue to see yourself as someone who earns and saves, your decisions will revolve around income and security. At $100,000, you are positioned to choose which identity you strengthen. You can reinforce the worker instinct, protect, accumulate, hesitate. Or you can cultivate the owner mindset, allocate, structure, deploy. The number alone does not create leverage. The structure behind it does. And once your money becomes a machine, even a small one, you begin stepping into a different financial reality. One where effort is no longer the only engine. One where time works with you, not just against you. One where growth is no longer accidental. It is designed. 6. The lifestyle trap at $100,000. There is a quiet danger that appears right after you cross 6 figures. It does not look like a mistake. It looks like reward. You worked hard. You were disciplined. You delayed gratification. You skipped upgrades while others spent freely. And now, finally, you feel justified in elevating your lifestyle. A better apartment, a newer car, more frequent travel, nicer dinners. Individually, none of these decisions are catastrophic. But together, they create something subtle. They anchor you back to the worker identity. Lifestyle expansion increases fixed expenses, higher rent or a larger mortgage, car payments, insurance, subscriptions, recurring commitments. Each new obligation increases the minimum income required to maintain your life. That increase raises pressure. Pressure reinforces dependency, and dependency keeps you tied to employment. This is how high earners remain workers. They upgrade faster than they build. It feels harmless at first because income supports the upgrades, but when expenses scale alongside earnings, margin disappears, and margin is the oxygen of ownership. Without margin, you cannot invest aggressively. Without margin, you cannot tolerate volatility. Without margin, you cannot think long-term. You're always thinking about the next paycheck. The lifestyle trap is powerful because it disguises itself as progress. Externally, everything looks successful. Your home improves, and your car improves. Your social circle reflects status, but internally, your financial structure has not strengthened. It has become heavier. Ownership requires lightness. Lightness means your fixed costs are lower than your earning capacity. It means you can redirect surplus into assets. It means your monthly obligations do not dictate your career decisions. Workers expand consumption first. Owners expand assets first. That order matters. If your first instinct after reaching $100,000 is to upgrade your visible life, you are reinforcing the habit of consumption over construction. Construction is less visible. It does not photograph well. It does not generate immediate social validation. It often looks boring from the outside, but construction compounds. The difference between a worker and an owner is not what they can afford. It is what they prioritize. At $100,000, you are capable of both upgrading your lifestyle and building assets. The constraint is not money. It is discipline. Discipline at this level is different from discipline during accumulation. Accumulation discipline is about saying no to unnecessary spending so you can save. Ownership discipline is about saying no to unnecessary upgrades so you can invest. The stakes are higher, because the dollars you deploy now have decades to compound. Every $10,000 redirected into a productive asset at this stage can multiply significantly over time. Every $10,000 redirected into consumption disappears. Consumption satisfies immediately. Assets reward gradually. The worker mindset seeks immediate reinforcement. The owner mindset tolerates delayed gratification. Delayed gratification is not about deprivation, it is about alignment. If your long-term goal is optionality, independence, and structural wealth, then aligning your lifestyle below your means accelerates the process. When expenses are moderate relative to income, you create buffer. Buffer creates flexibility. Flexibility creates opportunity. Opportunity is rarely available to those stretched thin. The lifestyle trap also affects psychology. When you upgrade your life to match your income, you normalize that level of spending. What once felt luxurious becomes standard, then ordinary, then insufficient. This is the cycle of lifestyle inflation. Income rises, spending rises, satisfaction resets. You run faster but remain in the same position. Ownership interrupts this cycle. Instead of expanding consumption with each raise, you expand assets. Instead of increasing fixed costs, you increase cash-flowing investments. Over time, your assets begin covering portions of your expenses. That moment changes your relationship with money. Because when part of your lifestyle is funded by assets rather than labor, your stress declines. Stress declines because survival is no longer fully dependent on performance. The lifestyle trap keeps stress high, even at high income. Ownership reduces stress gradually, even if income does not skyrocket. The choice at $100,000 is subtle but decisive. You can use the milestone to validate consumption, or you can use it to accelerate construction. Construction requires restraint. Restraint is not weakness, it is strategy. When you resist the urge to immediately upgrade everything around you, you give your capital space to work. You allow your machines to form. You prioritize infrastructure over image. Image fades. Infrastructure remains. 10 years from now, few people will remember what car you drove at 35, but you will feel the difference between having built assets and having built expenses. One path increases obligations, the other increases leverage. The lifestyle trap is tempting because it feels deserved. Ownership asks a harder question: do you want to look successful now, or be structurally powerful later? That question defines the trajectory from this point forward. Because once your fixed expenses expand significantly, reversing them becomes painful. Downscaling feels like failure. Cutting back feels like regression. It is far easier to maintain discipline early than to correct excess later. At $100,000, your foundation is forming. What you add on top of it, assets or obligations, determines whether that foundation supports growth or strain. The worker upgrades lifestyle to match income. The owner upgrades assets to outpace expenses. And over time, so that difference compounds into two very different lives. 7. The $100,000 decision. There comes a point where the math is no longer the problem. The income is solid. The savings are real. The discipline has been proven. At $100,000, the question is no longer, can you save? The question is, who are you becoming? Because this level of capital forces a shift in identity. Up to this point, you were a builder of savings, a disciplined earner, a responsible planner. Those traits got you here, but they will not automatically take you further. The $100,000 decision is not about where to invest. It is about how to define yourself. Will you remain a high-functioning worker, or will you step into ownership? This is not dramatic. It does not require quitting your job tomorrow. It does not require announcing anything publicly. It requires internal clarity. Not a worker with $100,000 still asks, how do I increase my salary? An owner with $100,000 asks, how do I increase my equity? That distinction reshapes every financial move from this point forward. Salary is limited by negotiation, market demand, and human capacity. Equity is limited by allocation, time, and compounding. Salary peaks. Equity scales. The $100,000 decision is a commitment to scaling rather than peaking. Peaking is about optimizing income for a few high-earning years. Scaling is about building systems that expand over decades. When you commit to scaling, your focus changes. You analyze assets instead of promotions. You study allocation instead of office politics. You think in cycles instead of quarters, and your time horizon extends. Time horizon is everything. A short time horizon makes volatility feel dangerous. A long time horizon makes volatility feel manageable. Owners extend their horizon intentionally, so they understand that 10 disciplined years of structured investing can transform modest capital into substantial leverage. But that transformation requires a decision early, because every year you delay deploying capital intelligently is a year lost to compounding. Compounding is neutral. It does not judge. It rewards participation. Participate early, and it accelerates. Participate late, and it struggles to catch up. The $100,000 decision is a declaration that your capital will participate. Participation means exposure to markets, assets, and productive systems. It means accepting temporary fluctuations in exchange for long-term growth. It means building layers. Layer 1 might be broad market index funds. Layer 2 might be real estate exposure. Layer 3 might be private equity or entrepreneurial ventures. Layer 4 might be reinvested dividends and profits. Each layer adds resilience. Resilience reduces fear. Fear is what keeps workers from transitioning. The workers fear loss more than they value leverage. Owners value leverage more than they fear temporary decline. This does not mean owners ignore risk. It means they define it differently. Risk is not price movement. Risk is structural weakness. Structural weakness means dependency on one income stream. It means high fixed costs relative to cash flow. It means no ownership of appreciating assets. At $100,000, structural weakness can still exist, so you can have 6 figures and still rely entirely on your job. The decision is whether that continues. Another dimension of the $100,000 decision is responsibility. When capital increases, so does responsibility for its direction. Small amounts of money can survive poor allocation without long-term consequence. Larger amounts magnify outcomes. Good decisions compound upward. Poor decisions compound downward. Ownership demands intentionality. Intentionality means knowing your risk tolerance, and understanding diversification, and aligning investments with a clear timeline. It also means resisting noise. News cycles are designed to create urgency. Market headlines exaggerate extremes. Social media amplifies both fear and hype. Workers react to noise. Owners filter it. Filtering requires confidence in structure. When your portfolio is diversified and aligned with long-term goals, short-term fluctuations lose emotional power. That emotional stability is part of the $100,000 decision. You are choosing to become someone who thinks in decades. Decade thinking changes behavior. You reinvest instead of withdraw. You hold instead of panic sell. You evaluate businesses and assets rather than chasing trends. And slowly, something shifts. Your job becomes optional rather than central. Optional does not mean irrelevant. It means your survival does not depend exclusively on it. When survival is no longer tied to employment, negotiation changes. Risk tolerance becomes rational. Career choices become strategic rather than reactive. You can pursue opportunities aligned with growth rather than fear. That freedom begins with capital deployment. Many people misunderstand the scale of impact $100,000 can have over time. They assume it is too small to matter significantly. They underestimate compounding. They overestimate the importance of a single big win. Ownership is not about dramatic breakthroughs. It is about consistent allocation. Consistent allocation creates predictability of growth over long periods. The $100,000 decision is not about chasing extraordinary returns. It is about designing a structure that makes ordinary returns powerful. And an average return applied consistently over decades can outperform sporadic attempts at high returns driven by emotion. Emotion is expensive. Workers are conditioned to seek validation, to chase visible wins, to avoid visible losses. Owners are conditioned to seek stability of structure. Stability of structure allows growth to unfold naturally. The transition does not happen overnight. It happens through small, disciplined decisions, repeated annually. Reinvesting dividends and increasing asset exposure gradually. Maintaining lifestyle below earning capacity. Avoiding concentrated risk. Each decision seems modest, but together they create a compounding engine. The $100,000 decision is therefore less about a single move and more about a trajectory. A trajectory toward ownership, a trajectory toward systems, a trajectory toward independence. When you cross this threshold, you can no longer claim ignorance. The tools are available. The capital is sufficient. The timeline is meaningful. The only variable left is identity. Are you someone who accumulates or someone who allocates? Accumulation ends when effort ends. Allocation continues through structure. That is the dividing line. The $100,000 decision is not glamorous. It does not come with applause. But it marks the moment you stop measuring your life by income and start measuring it by ownership. And over time, that measurement changes everything. 8. The shift from earning to owning. There is a moment when earning stops being impressive, not because it isn't valuable, but because it isn't enough. You can earn $120,000 a year. You can earn $200,000 a year. You can even earn more. If the structure remains the same, the dependency remains the same. The shift from earning to owning is not financial at first, it is psychological. Earning is transactional. Owning is structural. Earning says, I give time and skill, and I receive money. Owning says, I acquire assets. They produce. That distinction seems simple, but it rewires how you think about opportunity. When your identity is built around earning, you evaluate every opportunity by how much it pays you. When your identity shifts toward owning, you evaluate every opportunity by how much equity it creates. That changes your decisions. You begin asking different questions. And instead of, what's the salary? You ask, what's the ownership stake? What's the upside? What's the long-term growth potential? Instead of negotiating solely for higher pay, you negotiate for equity participation, revenue share, performance-based upside. You look for assets to accumulate rather than titles to collect. Because titles fade, equity compounds. This is the quiet evolution that separates long-term owners from lifelong employees. It is not about disrespecting employment. Employment can be powerful. It builds skills. It builds capital. It builds networks. But employment alone rarely builds independence. Independence is built when assets begin carrying part of the load. When 10% of your income comes from assets, your thinking changes. When 25% comes from assets, your confidence increases. When 50% comes from assets, your identity shifts permanently. The shift from earning to owning also affects how you use time. Workers trade time for money. The owners trade money for time. That reversal is profound. A worker may work 60 hours a week to increase income. An owner may deploy capital into an asset that reduces required working hours over time. Workers optimize schedules. Owners optimize systems. At $100,000, you are not yet financially independent, but you are financially capable. Capable of shifting, capable of building, capable of designing. The problem is not access. It is mindset inertia. Inertia keeps you doing what worked before. And saving worked before. Earning worked before. Being cautious worked before. But the strategy that gets you to $100,000 is not always the strategy that takes you beyond it. Accumulation mindset must evolve into allocation mindset. Accumulation says, keep stacking. Allocation says, place intentionally. Placement determines velocity. If you place capital in assets that appreciate and produce income, velocity increases. If you leave capital idle, velocity slows. And velocity is what separates moderate wealth from transformative wealth. Moderate wealth improves comfort. Transformative wealth improves freedom. The shift from earning to owning also changes your emotional landscape. Earning produces bursts of validation, bonuses, raises, promotions. Owning produces gradual confidence, steady growth, increasing equity, recurring income. One is episodic, The other is compounding. Workers are often conditioned to seek episodic wins. Owners learn to appreciate compounding stability. That stability is quieter. It does not produce headlines, but over time, it produces power. Power in the form of choice. Choice in the form of mobility. Mobility in the form of optionality. Optionality is the ultimate goal. Optionality means you can change careers without panic. You can relocate without financial strain. You can endure economic downturns without immediate crisis. Optionality is built when ownership reaches a scale where it supports your baseline expenses. That baseline begins with $100,000 deployed correctly. It does not happen instantly, but it begins with intention. The moment you view money as a tool for acquiring ownership rather than upgrading lifestyle, you have crossed into a different category. From this point forward, you evaluate progress differently. You measure net worth rather than income. You track asset growth rather than annual raises. You think about allocation percentages rather than spending categories. And gradually, the emotional grip of employment weakens. You still work, but you are not owned by your work. That distinction is subtle but powerful. Being owned by your job means every disruption feels threatening. Owning assets means disruptions become manageable, because your survival does not rely on one stream. It relies on structure. The shift from earning to owning is the final separation. Earning builds capital. Owning builds wealth. At $100,000, you stand between the two. If you continue to prioritize income above all else, you may become highly paid. If you prioritize ownership, you may become independent. Highly paid and independent are not the same. Highly paid depends on performance. Independent depends on structure. Structure compounds. Performance fluctuates. In the long run, structure wins. And once you make the internal decision to prioritize ownership, every dollar you earn from this point forward becomes a soldier for expansion, not just a reward for effort. That is the shift. From earning to owning. From effort to leverage. From working for money to making money work. And there is one more layer to this shift that most people don't talk about. When you move from earning to owning, your tolerance for discomfort changes. As a worker, discomfort often means working longer hours, taking on more responsibility, pushing harder for promotions. The discomfort is physical or mental effort. As an owner, discomfort often means watching short-term fluctuations without reacting. It means staying disciplined when markets dip. It means holding assets when others panic. It means reinvesting when it would feel easier to withdraw. The nature of discomfort changes. One kind of discomfort exhausts you. The other kind strengthens you. Earning more requires energy. Owning more requires conviction. Conviction comes from understanding structure. When you understand why you own what you own, why it generates income, why it appreciates, why it compounds, you are less likely to abandon it at the first sign of volatility. That stability is what separates temporary participants from long-term owners. And over time, ownership begins to influence more than your finances. It changes how you see opportunity. You start recognizing businesses differently. You evaluate industries differently. You notice inefficiencies. You think about scalability. You stop asking, how can I get paid here? You start asking, is there something here I could own? That question alone shifts your trajectory. Because once you consistently think in terms of ownership, every dollar you earn becomes fuel, not just income. Fuel for assets, fuel for equity, fuel for leverage. And slowly, almost quietly, your financial life becomes less about survival and more about strategy. That is the real transformation, not the number in your account, but the way you think about what that number can build. The difference between a worker and an owner is not how early they started. It is not how smart they are. It is not even how much they earn. It is how they decide to use what they have. At $100,000, you are no longer guessing, You're no longer experimenting with basic financial habits. You have proven discipline. You have proven restraint. You have proven you can delay gratification. Now the question is not whether you are capable. It is whether you are willing to shift. Because $100,000 is not the finish line. It is the moment where comfort tempts you to slow down and structure invites you to step up. You can choose to preserve it, guard it, protect it as if the goal was simply to avoid loss. Or you can choose to deploy it, structure it, and let it begin building something beyond your personal effort. The difference between workers and owners is not visible in the early years. Both can look successful, both can earn well, both can save diligently. But over a decade, the gap widens. Workers optimize income. Owners optimize equity. Workers upgrade lifestyle. Owners upgrade assets. Workers measure progress in raises. Owners measure progress in leverage. And leverage changes the game. Leverage separates income from hours. Leverage reduces dependency. Leverage creates optionality. Optionality is what most people truly want. Not just a higher paycheck, not just a nicer house, but the ability to choose. To choose where you work, to choose when you work, to choose whether you work. Choice is expensive, and it is paid for in advance through ownership. If you remain focused only on earning, you may build a comfortable life, but comfort without structure is fragile. It depends on performance. It depends on health. It depends on external stability. Ownership builds internal stability when assets produce income, when equity compounds, when systems operate without your constant attention. That is when stress declines. That is when fear loses its edge. That is when you realize money was never the goal. Control was. Control over your time, control over your decisions, control over your future. The $100,000 decision is ultimately about control. Will you allow your future to remain tied to your ability to work? Or will you begin building structures that carry weight for you? You do not need to be extreme. You do not need to be reckless. You do not need to gamble. You need to be intentional. Allocate consistently. Diversify intelligently. Reinvest patiently. Maintain margin. Small, disciplined decisions repeated over years outperform dramatic moves driven by emotion. This is not about getting rich quickly. It is about becoming structurally strong. Structural strength compounds. 5 years of disciplined ownership thinking can shift your trajectory. 10 years can transform it. 20 years can redefine it entirely. So most people never experience that shift because they stop evolving once they reach a comfortable milestone. They reach 6 figures and believe they have arrived. But arriving is not the goal. Becoming is. Becoming someone who thinks in decades. Becoming someone who values equity over ego. Becoming someone who prioritizes structure over status. When you make that internal shift, every dollar you earn from this point forward gains purpose. It is no longer just income. It is fuel, but fuel for assets, fuel for systems, fuel for independence. The number itself will not change your life. The structure behind it will, and years from now, when your assets are producing quietly in the background, when volatility no longer shakes you, when your time feels more flexible than it once did, you will realize that the most important moment was not when you reached $100,000. It was when you decided what it meant. The worker sees 6 figures as security. The owner sees 6 figures as responsibility, and that responsibility, handled correctly, becomes leverage. Leverage becomes freedom. Freedom becomes choice. And choice is the real definition of wealth. So the question is simple. Now that you have the capital, who are you going to become? Because the decision you make at $100,000 does not just determine your portfolio. It determines your trajectory. And trajectory over time determines everything.